This is Mijun from the United States Stock University, sharing fundamental United States stock investing tips. Today, July 2nd, let's dive into the latest United States stock news. Welcome to Mijun, where we stick to the basics of United States stock investing as always. Everyone, I'm not sure how you're starting this new month of July. As for me, I'm extremely busy right now because of the Mijun All-in-One membership promotion. Yesterday, so many people left questions in the comments and asked about the membership, so I was sweating all day answering them. And aside from the membership, there were also some good questions about investing. So today, I'll be answering some basic investment-related questions. This is a valuable comment left by Kim Soo-jung. Hello, I'm also a banding member, and I listen to your YouTube channel diligently. This is my first time asking a question. You said you cut your losses when the stock price goes down and buy when it goes up, but I'm curious about how you take your profits. As a beginner, pressing the sell button is the hardest part for me. It's tough for me too. Selling is nerve-wracking, and giving up profits while investing isn't easy. It's a process of admitting failure. But only by selling at the right time can we achieve healthy returns. First of all, if you invest in a stock and it starts to fall, it's better to just sell it no matter what. The same goes for stocks that are rising. We often say this: don't try to buy at the very bottom, buy when it's risen to the knees. And don't try to sell at the very top, sell when it drops to the shoulders. That's what people say. What that means is, if there's a range between 1 and 100, it's impossible to buy a stock at 1 and sell it at 100. So instead of trying to buy at 1, it's fine to buy at 20 or even 30. Once some momentum is confirmed and it's clear that it's a good stock, that's when you should buy. And then if the price keeps going up and reaches 100, you wait until it can't go any higher and starts to drop. Then you sell at 80 or maybe at 70. So the profit we can realistically expect is like that. For example, expecting profits from 30 to 60 or from 30 to 50, or if things go well, from 30 to 70, this kind of profit range is a realistic and safe way to invest, in my opinion. Let me give you an example to explain this. Among those of you watching this broadcast, some may remember it was around the middle of 2023. In September, I went to Korea and held an offline meeting with the Mizon family members. It's already been a long time, about 2 years ago. Back then, I shared with you the top 5 United States stocks selected by Mizon. Many strong stocks emerged during that period. Palantir and Uber, these stocks were around $15 or $16 back then, but now their prices are almost reaching $15.0. They're almost becoming 10-baggers. And at that time, I introduced a stock that many people didn't know about. That stock is called Supermicrocomputer Inc. I've been interested in Supermicrocomputer Inc. since early 2023. Then, around September 2023, I started buying it for the first time. Let me show you. By that time, it had gone up quite a bit. Around September, I think I bought it around the 22nd, maybe the 22nd or 24th. Back then, the stock price was around $200 accounting for the 10-to-1 split. That equates to about $20 today. So anyway, I made my first purchase somewhere between $200 and $250. At that time, I had an offline meeting in September, and there I included it in the top 5 best United States stocks selected by Mijun and introduced it to you all. I sent this video to you as a recorded broadcast on October 1st. If you're curious, I think it would be good for you to check it out. And I'll put the link to this video in the comments section or the description box. And then the next time I bought more was on October 20th. If you look here, I sold my Apple stocks and then I bought more. 6 shares and 12 shares of Supermicrocomputer Inc. So in total, that's 60 shares if you add them up now. This was before the 10-to-1 stock split. And if you look at the purchase price, it's $249 and $250. That's why, even after my initial purchase, I made additional purchases only after the stock price had gone up significantly. Because you can see that Supermicrocomputer Incu's momentum was just outstanding. Let's take a look at October 20th. October 20th is around this time. Now, looking at the chart, the upward trend hasn't even really started yet. So back then it felt really expensive, but looking at it now, it was actually before it went up. It was a golden buying opportunity. And when did I make another additional purchase? It was on November 2nd. If you look at November 2nd, 2023, I sold Tesla. And with that money, I bought 20 shares of Supermicrocomputer Inc., which would be like buying 200 shares now. Now, you might remember that at this time I got a lot of criticism. Tesla's stock price, currently at $214, has dropped sharply from its previous high of nearly $400. So, a lot of people criticize my trading, saying, does it make sense to sell now when Tesla's stock price has dropped this much? Alright, but let me briefly show you Tesla's stock price trend. It's November 2nd, right? From November 2nd to the lowest point now, Tesla's stock price dropped an unbelievable amount. From the point when I sold, it dropped an additional 33%. When a stock's momentum weakens like this, it's very unlikely that it's the bottom. It keeps falling until it tries to rebound, just like a ball that keeps going up after being thrown, and once it hits the peak and starts coming down, it keeps falling. We could see once again through Tesla stock that this kind of trend doesn't easily reverse unless it meets a catalyst. Supermicrocomputer Inc.'s stock price remained stable and even slightly decreased during that period. It shows that I bought at $233 and $229. Now I slowly start to sell. The first time I sold was on April 15th, 2024. That's when I finally started selling Supermicrocomputer Inc. But if you look at the stock price at that time, it was $899 and $895. Alright, let's see what it was like on April 15th. If you look here, this is the time. So April 15th. It hit its peak and then dropped a lot. It had fallen by more than 20% at that point. Supermicrocomputer Inc.'s stock is currently around $110, but previously reached $1,100. Following a 21% drop, I sold my shares for the first time. So usually when something drops by 20%, you should buy, right? But instead of buying, I sold. But if you look at it now, even back then, the stock price was already very high. So when the trend drops by 20% like this, it means there's been a shift, right? I thought the trend had turned downward, so I finally started to sell off my stocks. You can organize it like this. Now, if you look here, you'll see when I sold everything completely, it was on August 27th. On August 27th, I sold all my shares at $547. Let's take a look at what $547 means. It's August 27th. That would be around this time. But from that time until now, Supermicrocomputer Inc. has dropped by 23%. And that's after a significant recovery. Right now, it's down 23%. At one point, from the time I strategically sold, it actually crashed by nearly 70%. So, when a stock drops this much, we're talking about a 46% decline. I sold all my Supermicrocomputer Inc. shares when it had dropped 46% from its peak. A lot of people would buy stocks at this point, but for me, the fact that it dropped 46% means things are really bleak, and there's a high chance it will keep falling. Because the momentum is just too weak. That's why instead of buying at that time, I actually sold. As a result, you could say that I managed to avoid an additional 70% drop. When we buy and sell like this, what I consider most important is momentum. And as the momentum rises, the stock price goes up by about 30%. When it comes to the knee, that's when you start buying. As it keeps going up, let it be. Avoid making decisions too easily. No one knows how much this stock will go up. But when you see that the strong momentum is starting to fade and it starts dropping by about 10% or 20%, that's when I finally start selling. And as it keeps dropping, I continue to sell more. That's my momentum strategy, and that's how I would explain it. Ms. Kim Soo-jung, I hope this was a good answer to your question. Let's begin with the prepared United States stock news for July 2nd. Before I go over yesterday's United States stock market trends, I have a brief announcement to make. Tomorrow, July 3rd, I'll see you at the important next session. So on July 3rd and July 4th, there will be no regular broadcast of Ms. On for those 2 days. Please keep that in mind. What about the special Ms. On live broadcast I prepared for July 3rd tomorrow? This time, Chief Executive Officer Kim In-jung from Choice Star will be joining us. To mark the second half of 2025, we plan to introduce you to the top 5 stocks worth your attention and provide a detailed numerical analysis as well. For MeJune All-in-One members, I will send a separate participation link through a notice. And this time we've made special arrangements so that ChoiceStack members can also attend this lecture for free. As you can see here, Mr. Kim Sun-wook asked a question. I joined ChoiceStack through the discount link, so how can I participate in the special Thursday broadcast? He asked this question. Let me read Mr. Kim In-jung's message to you directly. Tomorrow morning, which is July 3rd, the link will be sent out to FC in the morning of July 3rd. And for those of you who haven't installed the app yet, the link will be sent via notification text message instead, so everyone will be able to receive the participation link. And this time, the live broadcast will be at 9 post-meridian Korean time. In that case, for example, if you're in Los Angeles in the United States, it will be 5 anti-meridian, so there may be some people who have trouble with the timing. In this case, you don't need to worry because you can watch the recorded broadcast anytime through the link we send you. One more thing, 미주초, short for 미국 주식 초등학교, means American Stock Elementary School. We will also send you a link tomorrow at 9 a.m. where you can download a portable document format containing all the materials from the broadcasts so far. And there's some really good news related to this. Chief Executive Officer Kim In-jung has shown great consideration. Originally, the United States Stock Elementary School textbooks were only going to be sent to ChoiceStar members, but this time, Chief Executive Officer Kim In-jung has decided to provide the United States Stock Elementary School textbooks free of charge to all MeJune All-in-One members as well. I would like to take this opportunity to thank Chief Executive Officer Kim In-jung once again. Now let's go over the United States stock market trends from yesterday. First, if you look at the S&P 500 map, some of you may have thought that the United States stock market was on a downward trend yesterday because most of the stocks we invest in went down, right? But actually yesterday, only the mega cap top stocks dropped. As you can see, most of the stocks are in green. And there are also Tesla, Nvidia, Broadcom, Meta, Netflix, and Palantir. Recently, only the stocks that had the most noticeable price increases experienced declines, so you can see it as a limited downturn. In fact, if you look at the performance of the 11 sectors that make up the S&P 509 sectors were in the plus yesterday, and only 2 of them went down. Communication services, which include Meta and Google, were down 0.71. Technology was down 0.89. So therefore, yesterday, only tech stocks went down. I think that's how you can sum it up. So therefore, if anyone was worried that the stock prices dropped yesterday and thought the United States stock market might be turning downward, there's no need to worry about that. Because the upward trend is still valid and very healthy. That's how you should see it. In fact, if you look at the market breadth of the S&P 500, it has improved a lot. Yesterday it was ranked 71, but if you look today, it has gone up to 79 and 76. So, among the 500 major companies that make up the S&P 500, you can see that as many as 80% of them currently have good short-term momentum. Also, the number of companies with good long-term trends has increased from 53% yesterday to now over 58%. Therefore, now, the market is evolving from a very limited rally led by only a few stocks to a healthier form where the overall market is rising together. This can be called market rotation. Now next is the VIX index. The VIX has actually improved, right? It has dropped to 16.84. So even if you look at the VIX index, you can see that there's no sign at all that the market sentiment is shaking right now. Next is the Fear and Greed Index. The Fear and Greed Index, as I said before, hasn't budged at all. It's just staying here continuously. This angle isn't changing easily. It's not overly hot, but at the same time, the atmosphere isn't cooling down either. It's staying very lukewarm, and this is maintaining a Goldilocks state. We can evaluate this positively. Now, the market score provided by ChoiceStar is the same. Even though it keeps staying at a high level like 83, 84, or 82, it's just staying there without budging. Therefore, I think it would be good for us to evaluate that it is continuing to maintain an upward trend. In contrast, the non-supported top picks performed poorly, with only 4 stocks rising yesterday. Next Tracker went up by 5.79%, Trade Desk was up by 2.08%, Bitcoin was up by 1.90%, and Amazon was up by 0.49%. These four stocks have one thing in common, right? If you look at their performance over the past week, it was just average. And if you look at their performance over the past month, except for Amazon, the top three are. Over the past month, there was almost no change, or they were in the negative. So the stocks that hadn't been doing well recently have seen their prices go up. So you can see the rotation happening here as well. The rest of the stocks were in the negative. Google was down 0.2% and moved sideways. In fact, Google's stock has only gone up 2.39% over the past month. So you can see that the stocks that didn't rise much actually had less of a decline. Taiwan Semiconductor Manufacturing Company fell 0.80%, Uber 1.25%, Meta 2.56%, Nvidia 2.97%, Thailand Energy 3.71%, Broadcom 3.96%, Advanced Micro Devices 4.08%, and Palantir 4.14%. As you can see, you can directly see that the stocks that had a good atmosphere recently have dropped a lot. Well, besides that, Bit2 is minus 4.45, Vistra is minus 4.49. Celestica is minus 4.61, Tesla is minus 5.34, and Credo is minus 5.40. Lastly, Strategy dropped by 7.65%, performing the worst. Right before me, yesterday's sharp drop in tech stocks is just a passing breeze. Because it's a movement of funds, that's how I explained it. Unlike us, there are traders with very short investment periods. So in cases like yesterday, traders who made a lot of profit from tech stocks took their profits. They invest the money in sectors or stocks that have significantly declined. That's one way to interpret it. So, since the overall atmosphere hasn't changed, I don't think there's any need to worry. If you look at the title of this article, it's very similar to the opinion I have. In fact, there's some really good news that actually supports an even stronger rise. The United States stock market. It's very welcome news that a strong buy signal has appeared for the first time in 2 years. Let's take a closer look at what kind of buy signal it is. The S&P 500 index is starting the second half of 2025 with a bang. On Tuesday, the leading index S&P 500 recorded a bullish signal, the Golden Cross, for the first time in 2 years. The Golden Cross is a popular indicator used by technical analysts as a measure of momentum. It occurs when the 50-day moving average crosses above the 200-day moving average. Usually, there are two methods. In my case, I use the 20-day and 60-day moving averages. Using these two is very useful for observing short-term trends, and what's shown here is the 50-day and 200-day moving averages. In this case, it's useful for looking at longer-term or medium-term trends. That's how you can understand it. What about the S&P 500 index? Since February 2nd, 2023, when the current bull market began, there hasn't been a single golden cross. So you can see this is good news coming after a very long time. And in fact, since the golden cross appeared on February 2nd, 2023, the S&P 500 has risen by as much as 48%. So it's been confirmed recently that when a golden cross appears, it's really good news. Now, of course, Tuesday's Golden Cross is not the first bullish technical signal to appear since the United States stock market began its recovery journey. There is something called the Zweig breadth thrust indicator, which occurs very rarely. I don't know if you remember. Back in April, I announced this news on a site run by Topney, and I also shared it on the broadcast. Do you recall the Zweig indicator from earlier? It initially emerged at the end of April, just as the rebound was gaining momentum. And the Zweig indicator has been extremely valuable information with a perfect track record of predicting further rises in the stock market at least since 1982. And in fact, the stock market has continued to rise since the end of April, so you can say that the Zweig indicator was accurate this time as well. Craig Johnson, the chief market technical analyst at Piper Sandler, appears. He considers Tuesday's Golden Cross a definitely positive sign for the market. Considering the market participation and growth, we anticipate a robust second half of the year. Usually there are leading stocks, so the leading stocks run first, and then when the market heats up, a full-fledged bull market begins where everything rises together. Thanks to the current favorable conditions, we can expect the bull market to continue for now. Evaluating the situation this way seems appropriate. And now comes the most important historical statistic. As I always say, When it comes to United States stocks, we invest while looking toward the future, and nothing about the future is certain. So, as investors betting on an uncertain future, we need some kind of basis. And among these, the most reliable basis is historical statistics. That's what I personally believe. Historically, the Golden Cross has reliably signaled further upward movement. Let's take a look at what that means. According to data going back to 1928, after a Golden Cross occurs, the S&P 500 index has risen with more than a 71% probability after 1 year, and the average one-year return has exceeded 10%. Now take a look at this. Here, you see both the average and the median. The average is the mean, but the median is more important because the median represents the middle value. The average can be significantly affected if there's a very high rise or a big drop at one time. So usually when we look at statistics, we consider the median or the middle value to be more important. That's how you should see it. Since 1928, the S&P 500's performance after a Golden Cross shows the trend of stock prices following the event. There is little to no change over 1 week or 1 month. Crucially, in the 6 months after, the average rose by 4.6% and the median grew by 5.5%. The probability of an increase is now as high as 73.6%. After 1 year, the average is 10.3% and the median is 12.1%. The probability that the stock will have gone up is 71.7%. This is a very high figure, so let's examine the average. Since 1928, regardless of the Golden Cross, the average 12-month return of the index over any 12-month period was about 8%. Normally it would go up about 8%, but it actually went up 10.3%. This figure spans from 1928 to the present, covering the performance over the last century. This time, I pulled out statistics just for the recent figures. Now, over the past 20 times starting from 1982, there have been 20 Golden Crosses. Let's take a look at how the returns were after that. Now, if you look here, there's the average and the median. First, if you look at the 6-month mark, the probability that stocks have gone up is 95%. So in most cases, they went up. There were hardly any times when they went down. You can see it that way. And on average, they went up by 8% over 6 months, and the median growth rate is 6.3%. Over a 12-month period, the stock price has an 85% probability of increasing, with an average increase of 13.4% and a median of 13.1%. Therefore, if you look at recent records after the last 20 Golden Crosses, stocks tend to rise significantly, and the probability of them going up is also very high. That's how we can summarize it. Another expert appears. Mark Arbeiter, the president of Arbeiter Investments, comes on. He says that the Golden Cross has worked as an excellent signal to take a buying position in the stock market. He also says that the bullish signal, the Golden Cross, is much more reliable than the bearish signal, the Death Cross, where the 50-day moving average falls below the 200-day moving average. So, there is the Golden Cross where the 50-day moving average breaks above the 200-day, and the Death Cross where the 50-day breaks below the 200-day. Anyway, the Golden Cross has a higher probability of being accurate than the Death Cross. He's talking about historical statistics, and recently there are other notable Golden Crosses in the stock market. First, the Nasdaq Composite had a Golden Cross on Monday, and Nvidia, which is an artificial intelligence beneficiary stock, recorded a Golden Cross on Friday. So recently, Golden Crosses have been happening here and there. Nvidia formed a Golden Cross on Friday, the Nasdaq on Monday, and the S&P 500 on Tuesday, reinforcing the overall upward trend. That's the proper perspective. Alright, so here's what I did. You likely want to know the probability of the Nasdaq rising after a Golden Cross and the average return in such cases. So I organized some historical statistics, and there's some good news. The Nasdaq index contains many tech stocks that are trend sensitive. That's why, after the Golden Cross, the expected returns were actually higher than those of the S&P 500. Now, one more thing. If the S&P 500 Nasdaq and Dow Jones all show a Golden Cross at the same time, there are also statistics showing that the performance improves significantly. Let's focus solely on the Nasdaq's Golden Cross, disregarding other indices. After the Nasdaq displays a Golden Cross, we'll examine the subsequent stock price trend. Since 1971, the Nasdaq index has made a total of 20 Golden Crosses up to now. And then, the probability of rising 3 months after that is as high as 79.3%, and the average return is about 5.55%. Now, if you look at the probability of an increase after 1 year, I couldn't find the data for that. But for the NASDAQ 100 index, that probability was as high as 90%. Isn't that amazing? And the average return, based on the NASDAQ index, is as high as 16.75%. So, compared to the S&P 500, the NASDAQ is actually much more sensitive to the Golden Cross. You could see it that way. Now, what we know right now is that the Golden Cross has already occurred in the S&P 500, and it has also happened in the NASDAQ. But now only one remains. If the Dow Jones also experiences a Golden Cross, then all three major indices will have a Golden Cross at the same time. There have been 12 cases like that since 1972. And then the probability of an increase 1 month later was 75% with an average return of 5% in 1 month. After 12 months, the probability that the NASDAQ went up was 91.7% and the 26.1%. Therefore, if the Dow Jones also forms a Golden Cross this time, it would be very positive news, so we can look forward to it. Most of the mid-June top 80 have already formed a Golden Cross. Especially with Nvidia also showing a Golden Cross on Friday, there are only 5 stocks left that haven't formed a Golden Cross yet. The first is Advanced Micro Devices, the second is Amazon, the third is Trade Desk, the fourth is Alphabet, and the fifth is Tesla. Therefore, if these stocks form a Golden Cross in the future, it could lead to further gains. I think it could also be interpreted in the opposite way. Tomorrow on July 3rd, I will be meeting with the Mijun members and the ChoiStar members, and based on my personal judgment, I plan to reveal the top 5 stocks that we should pay attention to in the second half of the year. If you look at this article, Wedbush is also revealing their top 5 picks for the second half of the year. First of all, as you know, Wedbush is an investment firm that really likes tech stocks, and recently Wedbush launched an exchange-traded fund. Let me show you for a moment. If you look here, IVES is the ticker name, IVES. The official name is Dan Ives Wedbush Artificial Intelligence Revolution Exchange Traded Fund. That's how you can see it. If you look here, the expense ratio fee is 0.75%, which is a bit expensive. If you invest about 100 million won, the fee alone comes out to about 750,000 won every year, so the fee tends to be a bit expensive. If we're investing in the artificial intelligence revolution, this is an exchange-traded fund worth paying attention to at least once. That's how you can look at it. Alright, then the top 5 should all be listed here in the top holdings. Let's take a look at the top holdings, the top 10 of the exchange-traded fund managed by Ben Ives. First, Microsoft accounts for 5.69% of the funds, making it the stock with the highest weight in this exchange-traded fund. Second is Nvidia, which is almost the same at 5.37%. Third is Broadcom, accounting for 5.19% of the funds, and Tesla has the fourth highest weight. 4.85%. Fifth is Taiwan Semiconductor Manufacturing Company with 4.54%. Meta is also included at 4.49%. Palantir at 4.46%. Amazon at 4.40%. Google at 4.28%. And finally, Apple accounts for 4.27% of the funds. If you look at the top picks, most of the stocks are in the top picks. And right now, only Microsoft and Apple are not included in the top picks. That's how you can see it. Now let's check for ourselves which 5 stocks are the top picks for the second half of the year among these stocks. Wedbush Securities announced on Tuesday that, thanks to artificial intelligence, the overall tech sector will rise by more than 10% in the second half of 2025. That's an amazing outlook. Tech stocks have already gone up a lot so far, but they're saying tech stocks will rise another 10% in just the next 6 months. They're predicting a very rosy future. The 5 top preferred stocks picked by this company are Nvidia, Meta, Microsoft, Palantir, and Tesla. The logic behind our bullish outlook is that investors are still underestimating the massive wave of growth that will come from the $2 trillion in corporate and government spending over the next 3 years, centered around artificial intelligence technology and its use cases. So, what is the reason Wedbush expects stock prices to perform very well in the second half of the year? Right now, many investors are underestimating artificial intelligence. Artificial intelligence technology and its applications will keep growing. So over the next 3 years, both companies and governments will pour so much money into artificial intelligence that spending will eventually reach $2 trillion. There are too many investors ignoring this part. Even now, there's a lot of cash sitting on the sidelines in the market. So, It can be understood as an argument that there's still plenty of room to run. In our view, after weathering several months of tariffs and geopolitical storms relatively well, tech stocks are now ready for another rise of over 10% in the second half of 2025, led by the winners driving the golden age of the tech world. Well, that's true, because things really haven't been good since 2025 began. There were tariffs and also geopolitical storms with China. On top of that, there was even a war. There were all kinds of bad factors. But despite that, we endured well. And there's one important thing. The market is very tolerant of risks that are already out there and well known. Barring an unexpected negative event or black swan, we can't anticipate a major decline solely based on the known negative factors. That's the proper perspective. Although there have been many negative factors in the future, these known issues won't be able to turn the stock market trend downward. Therefore, it's understandable to expect that tech stocks will continue to rise by more than 10% in the second half of the year. They also add that artificial intelligence use cases are exploding and corporate spending will increase as well. Another positive catalyst includes the launch of large language models as well as the genuine adoption of generative artificial intelligence by companies amid ongoing efforts to reduce costs and improve productivity. That's all for now. In fact, many companies have only dabbled in artificial intelligence so far. There aren't as many companies actually using it in earnest as you might think. And I've told you this before, right? What's the most important first step in finding a true growth stock? The market penetration rate is quite low. As I mentioned before, investing in the top company with the largest market share is a good strategy. A low market penetration rate means that not many people are using it, and not many companies are using it either. From what I see, artificial intelligence still doesn't have a very high market penetration rate yet. If we take a moment to think about how many people are actively using artificial intelligence, and how many companies in the world are increasing their efficiency and boosting their sales through artificial intelligence, we can see that the market penetration rate is still not that high yet. Therefore, the key going forward will be the explosively increasing use cases, and it is expected that software and chips will continue to drive technological innovation at least until the second half of 2025. Therefore, this suggests that our bullish outlook on tech stocks and the artificial intelligence revolution will become even more of a reality over the next 12 to 18 months. Now, looking ahead, the number of cases using artificial intelligence will increase explosively. That means we'll need even more GPUs, right? And all these applications appearing everywhere can create a lot of wealth. If that happens, there will be beneficiaries all over the place. So the bullish outlook on tech stocks and the artificial intelligence revolution theory will remain valid for at least the next year to a year and a half. Now, I've analyzed the fundamentals of the 5 stocks mentioned here. Let's take a look together. Based on the quant rating, all 5 stocks are rated as hold, indicating in the case of Seeking Alpha, no matter how good the fundamentals of a stock are, if there's even a single issue, they never give a buy rating. And all 5 of these stocks are currently failing in terms of valuation. Therefore, you can see that it's difficult for the quant rating to turn to a buy in this situation. Secondly, the analysts associated with Seeking Alpha have given buy recommendations for 3 stocks: Nvidia, Meta, and Microsoft. And as for the analysts working on Wall Street, they are recommending buying these 3 stocks: Nvidia, Meta, and likewise Microsoft. These 3 stocks are currently the most highly rated in the market. That sums it up. Next is the quant factor. As I mentioned earlier, all of their valuations are at an F grade. Because of this issue, their quant scores can't go above 3 or 5. That's why they didn't receive a buy recommendation. This is something we need to remember. However, despite that, the rest of the fundamentals are generally very good. Except for Meta and Microsoft, the growth rates are all either A or B. As for profitability, they are all A plus or A. The momentum is also good for all of them. Lastly, what about the earnings per share revision? Nvidia and Tesla are showing slightly weaker performance. That's how we can sum it up. You said the valuation isn't good. Let's examine just how high it is. If you look here, there's a PE gap. Let me explain what that means. The upcoming 1 year forward is a calculation of the market capitalization's inflation compared to the expected net profit over the next year. Nvidia's stock price has risen significantly to the $38 to $64 range, causing its PE ratio to increase substantially. Before that, it was in the mid-20s, so you end up regretting again that you didn't buy it back then. And in the case of Meta, it also rose up to 28, even 69. Microsoft is at 37 times, and Palantir is at 404 times. And right now, in the case of Tesla, the price to earnings ratio has gone up to 200, even 300. When evaluating these PRs, you shouldn't just look at the absolute numbers. You have to compare them with the growth rate. So you have to consider how the earnings these companies generate will grow over the next 2 or 3 years. So in the case of Nvidia, if the earnings growth rate exceeds 38.6%, then a price to earnings ratio of 38.6 times can be justified and is acceptable. That's how you should look at it. Now, similarly, if Tesla's earnings are expected to rise by more than 200% over the next 2 or 3 years, then a price to earnings ratio of 203 times can also be justified. It's the same for Palantir as well. So when you evaluate valuation like this, you must always check the growth rate, and that growth rate refers to the earnings growth rate. That's how you should see it. Next, let's examine the growth rate, starting with revenue. Looking at the revenue growth rate. Over the next year, Nvidia is expected to have a 60% growth rate, Meta 16.5%, Microsoft 14%, Palantir 31%, and Tesla is expected to have a 6.59% growth rate. Now, if you scroll down, you'll see earnings per share. This is earnings, right? As for earnings growth rates, Nvidia is at 64%, Meta at 24%, Microsoft at 16%, Palantir at 43%. And for Tesla, the consensus has dropped a lot recently. So we can summarize that negative growth is expected. And there's one more thing we need to consider. When there is such a consensus, whether it exceeds it or falls short of the forecast is also a very important investment indicator. You should see it that way. Next is the rate of return. At the very top, there's the gross profit margin. The gross profit margin refers to the margin remaining after deducting the direct costs required to generate sales. Nvidia, 71.1%, Meta, 81.7%, Microsoft, 69.07%, Palantir, 80%, Tesla, 17.6%. That's because it's a company involved in manufacturing. When making cars, a lot of costs are included as direct costs. And what's noticeable here is that most of the items are showing extremely high profit margins. Therefore, this means that these are companies that can secure a certain level of net profit just by reducing operating expenses. If you actually look at the net income margin, Nvidia is over 51%. Meta is at 39%, Microsoft is at 35.7%, Palantir is at 18.3%, and Tesla is at 6.38%. Now, in the case of Nvidia, when we do business, if the revenue is 1 million won, I get to keep over 510,000 won of that amount. It's truly an amazing business model. Now, let's look at return on equity, how much net profit we make from our own capital. If you look at this, it's even more incredible. Nvidia turned 1 million won into 1.15 million won in a year, representing an extraordinary investment return. Meta gives a return of 39.8%, Microsoft 33.6%, Palantir 12.3%, and finally, Tesla is giving a return of 8.7%. But even in the case of Tesla, if you invest 1 million won, you only get about 4% or 3% if you put it in a savings account. So I can say that even 8.7% is an excellent return on equity. Now lastly, let's take a look at the balance sheet. If you look at the total debt to equity of these 5 stocks, you can see how financially solid they are. What is total debt to equity? It measures how much debt you have compared to your own equity. Nvidia is at 12.27%. Meta is at 26%. Microsoft is at 32% and Palantir is at 4.43%. So what this means is, if Palantir has 1 million won in equity, its debt is only 44,300 won. You can see that it has almost no debt. Tesla also boasts a very low figure at 17.4%. We've analyzed the fundamentals of these 5 stocks. When we build a portfolio and continue to rebalance it, we need to consider the fundamentals, as well as the investment story and future outlook of each stock. I want to emphasize that you should regularly review and adjust your portfolio by taking these factors into account. The last content prepared for today is the Me June podcast. The main topic of today's podcast is Nvidia. Earlier, we analyzed the 5 stocks recommended by Wedbush. As you may have noticed from the analysis, there is currently no stock that can surpass Nvidia in terms of fundamentals. And as I always say, Nvidia still holds the largest portion in my portfolio. That means, even at this point, I view Nvidia the most positively. You can take it that way. Now, the podcast we're going to listen to together this time is the reason for aggressively buying even at an all-time high. I made an article about this into a podcast. Now, it seems that the analyst who wrote this article also has a very positive opinion about Nvidia at the moment. Now, through this podcast, it would be good for you to check for yourselves what kind of logic the author is presenting in this article. That concludes today's July 2nd broadcast. I sincerely appreciate everyone who watched until the end. And let me say once again, tomorrow, July 3rd, I'll be doing a special live broadcast with the Mijuan members and the ChoiceStar members. So, unfortunately, Mijuan's Today's United States Stock Broth will be taking a break for one day. And on Friday, by coincidence, the United States stock market will be closed. So, once again, I want to let you know that Mijuan will not be broadcasting for 2 consecutive days, Thursday and Friday. Let's all keep fighting together until the day we all retire through investing in United States stocks. Have a happy day. Thank you.
Hello everyone, I'm back again. This time, there's an analysis article about our favorite stock, Nvidia. This article explains why people keep aggressively buying it, even though it's at an all-time high. I'm going to take a closer look at this.
Today's goal is to address recent concerns like insider selling and valuations being too high. Despite that, we'll dig into why this author remains positive about Nvidia and examine his reasoning. All right, shall we get started?
Yes, sounds good.
I believe this is the article's main point. Don't pay too much attention to insiders selling their stocks. Instead of that, you should look at the real fundamentals of the artificial intelligence market, especially the free cash flow. In other words, how explosively the free cash flow is increasing.
Free cash flow is important. Yes.
The author states that 30% of his portfolio is in Nvidia, demonstrating a very strong conviction in the company. Of course, I also have a positive view of Nvidia, and Nvidia has the largest share in my portfolio, but right now it doesn't exceed 20%.
30% is really a big portion.
But the part the article points out about insider selling is interesting. Actually, this could be a bit misleading.
Misleading in what way?
A lot of these sales actually happen according to a prearranged plan called Rule 10b 5-1. Insiders pre-plan when, at what price, and how much stock they'll sell, then follow through. It doesn't mean they're suddenly selling due to something bad happening to the company.
Oh, so there are such plans? Then it means they're not just selling based on the market situation, right? Yes.
That's right. And another thing is that the scale of the sale itself is actually a very small part compared to the massive size of Nvidia's total market capitalization. You have to look at the context.
I see. If you just look at the news about insider selling, it can make you a bit anxious. But it's important to know the story behind it. So that's why the author is telling us to focus on companies with free cash flow, the real cash they actually have in hand.
That's right, in the article.
Looking at the numbers in the article, last quarter's free cash flow was a whopping $26.1 billion, and there's even a projection that it could exceed $100 billion for the whole year. It said that they've exceeded Apple in quarterly free cash flow.
That's the really amazing part. It means their ability to generate cash is tremendous.
You mentioned the need to view free cash flow growth from a broader perspective, particularly in relation to data center investments, correct?
Currently, data center facility investments, or CAPEX, are increasing explosively. Predictions estimate that by 2028, annual investments will surpass $1 trillion, equivalent to over 1,300 trillion won.
$1 trillion? Wow, that's an unimaginable amount.
That's right. The reason is that we need to keep improving artificial intelligence performance, and funding for artificial intelligence startups is also increasing. Plus, there are talks about massive data centers using millions of GPUs. On top of that, the concept of artificial intelligence factories is emerging, and countries are even competing in a so-called small-brain artificial intelligence race to strengthen their own artificial intelligence capabilities. All of these things are interconnected and happening together. Wow.
There really are a lot of factors working together, aren't there?
One of the perspectives in this article is that the market might not yet be fully reflecting the true scale of this massive artificial intelligence investment cycle, this multi-year supercycle. That could be
the case. So the author thinks that the current market revenue forecasts for Nvidia are too low, right? Yes.
The current consensus for 2030 is about $322.8 billion, which is deemed insufficient.
Then how much does the author expect?
The author assumes an average annual sales growth of about 25%. If that's the case, sales could reach around $488.3 billion by 2030. And if they maintain a margin of about 50% here, the annual FFC could reach as much as $245 billion.
Wow, and free cash flow of $124.5 billion is bigger than the total revenue of most big tech companies.
Exactly. That's the level of cash generating ability they're expecting.
So the current stock price has a PE ratio of about 27 times. Do you think that's not expensive? Right.
The author's argument is that considering the growth potential, a PE ratio of 27 right now is reasonable, or it might even seem cheap.
Is there not much difference compared to its competitor, Advanced Micro Devices?
Yes, Advanced Micro Devices' PE is around 24 right now, so compared to that, it's hard to say it's highly overvalued.
Especially Nvidia has a very high free cash flow conversion rate, which means it turns its profits into cash at a very high rate.
Additionally, Blackwell and Rubin represent strong new product pipelines. The company has guided that margins will further improve in H2. Considering the significant capex increase mentioned earlier, the current valuation seems fully justified.
So that's why they've set the target stock price quite high.
Yes, they've set a target market cap of $7.35 trillion by 2030 and a stock price target of about $300.
Wow, joining the $7 trillion club. Of course, there must be some risks as well. Does the article mention them?
Yes, of course, they address that. The biggest risk is obviously that one. A scenario where data centers or hyperscalers cut back on GPU investments more than expected. The author thinks that's unlikely, but it's still a possibility.
Right, is there anything else?
We could also consider cases like profitability suddenly worsening due to unexpected intensification of competition, or competitors like Advanced Micro Devices taking market share faster than expected.
Yes, we always have to keep those risks in mind.
Still, the author's conclusion is resolute. Nvidia is now fully focused on expanding Blackwell production, and also has a strategy of releasing new products every year. Next is Rubin. This will make data centers keep buying the latest chips. 1 year.
So releasing products on a yearly cycle could be a key driver, right? Yes?
So the market is still underestimating the rapid increase in capex triggered by artificial intelligence, so even insiders shouldn't be swayed by short-term issues and should keep buying aggressively. That's the final conclusion.
So if we sum up all this analysis in the end, this article is telling us to look at the big picture rather than short-term noise.
Is that right, insider?
Rather than focusing on headline news like sell-offs, we should evaluate Nvidia's potential for sustainable growth by concentrating on the fundamental cash-generating ability brought by the artificial intelligence revolution. In other words, its free cash flow potential. That's the message I get from this. Actually, I think this perspective is also worth considering when looking at other high-growth tech stocks. Over on the Midjourney channel videos and in the membership, they keep emphasizing this kind of fundamental analysis as well. So,
lastly, I'd like to ask this question. As we've seen today, the artificial intelligence facility investment boom is really enormous, just as predicted. If NVIDIA's dominance continues, isn't it possible that even today's optimistic outlook might actually underestimate the true scale of the changes ahead and the role NVIDIA will play in them?
wow, that could be possible. Or on the other hand, is there something we're missing? Yes.
Or could it be that we're overlooking some unexpected changes in the competitive landscape or perhaps some technological limitations? That's why we need to study investing together even harder and create an enjoyable investment journey together.
That's all for today's analysis article. I hope this was useful and thank you for joining.
Whatever you do, the beginning of a dream is important. Let go of greed and grow little by little every day. Enjoy today's journey. Even if dark times come, I'm not afraid. Retire with United States stocks.